Okay, well, good morning, everybody. Good afternoon to some of you. I'd like to welcome you all to the month in review here on our Energy Markets podcast. I'm delighted to be joined by Christoph Ruhl and Mike Muller, two of our regular commentators and experts here on the program. Thanks so much for joining us, Christoph and Mike.
Good morning to you. I think good morning for you.
Yeah. Christoph, let's start you, please, regarding basically the month that has just passed. You know, we are now at the beginning of March. To my impression, I seem to be feeling that things are a little bit more steady in the oil markets. You know, we've seen the oil price range not move too much in the last month or in the last 2 months. What's the outlook going forward, in your point of view, in terms of the volatility that we might expect?
I think when you talk about oil markets without big exogenous from the outside changes, they will continue to tread water and trending down a little bit without disturbances. But I think when you really want to talk about oil prices and uncertainty, we still have the situation where it's essentially A, impossible to forecast, and B, because it all depends on the war situation at the end of the day. So that's where you go from the war and then to the economic sanctions, and then you get the oil price. I think is the moment, is the right order. And when you read the average newspaper, there seems to be the opinion that we have in front of us a pretty stable year in terms of the military conflict, a war of attrition which goes on forever. I don't think so. I think I try to follow this military thing also very closely, although I'm not an expert. But I think all signs were for the Russians to launch an offensive now before the thawing period and the rainy period comes, which by and large took place but failed. It was not successful. The idea was to just at least conquer these 4 provinces they have formally annexed. And the second idea will be for the Ukrainians to do the same when in the spring when they have these new tanks and so. And to me, that looks like, just from reading newspapers, no special knowledge here, but it looks like as if the West has decided that they will back up Ukraine, at least to the point where Ukraine drives a wedge between the Eastern Front and the Southern Front and is able to threaten Crimea in the hope that this may trigger developments in Russia, which may make it possible to enter negotiations. And if that happens, and if that is successful, which is what I would assume, we should see big impacts on the oil market, because either Russia finds itself with the back to the wall and then they will use the oil weapon, I think, as a last resort, or it becomes an unstable military situation. The sanctions will have to ratchet up. The political solidarity of the collective West is being tested, and all of that will also play itself out in oil markets. So in either case, I think we face some turbulence on the market, not this kind of stability which you say people have gotten used to now.
Okay, thanks, Christoph. Mike Muller, head of Vitol in Asia, thanks for joining us again. Mike, would you agree with that we're not going to see more stability this year? And Christoph referred to the fact that how Russia may react to an escalation in the war or response to the fact that it's losing ground. But there's also been lots of commentary in the market that Russia's control over how much it can produce and export is actually beginning to weaken. So give us a bit of a feeling there of how much Russia can continue to do what it was doing all throughout last year. Impact on prices.
Well, I'll start off by saying I'm not going to be a political commentator or a war expert here. But of course, the attention of the oil markets has focused largely on the signals coming out of Russia in the context of the price cap legislation that G7 and a bunch of other nations have introduced. And the focus now is on the comments by Deputy Prime Minister Alexander Novak about a month back now, that Russia would take about 500,000 barrels a day of production off the market. At a time, of course, when refining margins were still very good, and therefore there was initial curiosity whether this would apply to refined products, which had been subject to price cap. Of course, crude was already in a more steady state, having had a price cap introduced 2 months prior, or indeed whether this would affect crude oil production. And then immediately, and we did so on this call a few months back, people start speculating whether the Russians have any technical reasons why absence of foreign technology in the subsurface exploration and production, or indeed in refining, might become a pinch point. And I think the consensus of the market was that on initial evidence 1 year in, Russia seems pretty self-sufficient in terms of its technical capabilities. So I think there might have been some exaggerated views there. And on the strength of what we're seeing in markets, Russian oil continues to load and get on ships. The price cap discussion, of course, has created a bit of a realignment in trade flows because the more important and more easy to understand aspect is the import ban into the EU, which sees very large quantities of Russian diesel and fuel primarily redirected to markets further afield. And it doesn't take much to figure out that that's going to tie up ships for a lot longer and longer voyages. But it's compounded by the fact that we have the spring turnaround season. So in the case of crude oil, there's a little less demand. We also see weakening in demand in Asia, in particular after the winter peak in demand. And the uncertainty over whether a original supplier of Russian origin fuel, naphtha, distillate, or indeed crude is able to give an attestation when it's been made very clear to off-takers that such attestations on price cap will not be issued by the original supplier in Russia, leaves the market with a lot of head scratching. Because just finish off Diallo quickly. It is obviously those parties that provide the services that have to be very vigilant: the insurance companies, the ship owners, and indeed the banks that are providing the services. That they now have to tiptoe around legislation that's been issued not by one jurisdiction but by 3 separate jurisdictions: the US, the EU, and the UK. And finding alignment there is taking the market some time.
Yeah, and I mean, you mentioned one thing that you mentioned there, Mike, was the shipping. That's one aspect of it, as you said. And for example, we've seen a lot of Russian oil going into India in the last few months, more than obviously the average does. But the one thing that apparently is standing in that continuing isn't the discount and the great deal that India is getting, but it is perhaps vessel tightness. Do you feel like that? I know that, you know, they've got the dirty tanker market out there, but will that tightness in any way interfere with the flow of Russian volumes at all, do you think, this year, with the product sanctions now compounding on top of the crude, and with both of those?
There are so many factors. There's what happens every winter, which is shorter daylight hours and fog, and therefore disruptions in places like the Houston Ship Channel, in places like the Bosphorus, and in places like Panama Canal, all of which are congested or have had issues in recent weeks. Then there's the extra ton miles being consumed by Russian oil having to travel further distances. And finally, there's the extra shipping capacity that's absorbed with owners of cargoes not knowing what they can and cannot do, and their customers also not knowing whether or not they can buy. And all that is very, very clearly serving to drive up freight rates in various classes of vessel. Absolutely.
Okay, Christoph, let's talk a bit about demand. We've talked about price a bit, supply. You started by saying, no, we are going to still see quite a lot of volatility in that price because of different factors, the war being one of them, obviously, that interruption. But a few people we've talked to in the recent weeks are saying, you know, energy supply is no longer a worry in terms of price. In fact, what really is worrying people is stagflation that's on our doorstep. And sort of economic uncertainty, not energy per se. Would you agree with that? And what's the outlook there in terms of sort of economic GDP concerns? Many people saying we're not going to see a recession in Europe or in the US now anymore.
I think it's probably, to answer that question, whether it's energy or not, best to start with these 2 price caps. Because I don't think that this is, you know, just so many factors that we can't really predict anything. There's in each of these price caps for crude oil and for products, there's a big question mark. One, in the crude oil market, it's so flexible, and the readjustment has been so smooth by markets that Russia not only continues to export its crudes into Asia, it's notable to me that they continue to increase exports only into India, China, and Turkey. There's all of emerging markets. There are all these countries. When you look them up, they all have sizable consumption needs. They all have refineries, so they can, to some extent, choose between crude and product imports. And they have asked, Bangladesh has asked, Pakistan has asked to get parts of those flows, and they haven't gotten them. Now, you could say this is lack of Russian infrastructure, but after a year, I think this is very implausible. I do think that Russia, for strategic reasons, forgoes the option of bringing down the discount by having these other emerging markets compete for Russian crudes and delivers it cheaper than it would have otherwise into India, China, and Turkey in order to secure their support in others. And what plays into that when you think down the road is also these trades now denominated in dirham to some extent, joining the alliance. We want to move out of the dollar trading area. So there is scope still for strategic decisions like that. That's important. And then on the product side, I don't share this pessimism about longer voyages for two reasons, but there's another problem. So the comforting thing here that market adjustments will take place relatively smoothly is that there's actually an opt-out clause. Every country can import Russian products which have been blended with Russian crude in a third country. So what you see is a huge uptick in imports into places like the Middle East, and then outflows from there, and you can't really prove where they're from. But it's not illegal to import them if they have been blended in any other country using Russian crude oil. And there's no restriction on the share of Russian crude oil which can be used. So I don't expect these major reorganizations, because even in this indirect way, Russian crude oil in the form of products will find its way into Europe. What is the issue here is also, in my view, less technology, but storage capacity. Russia doesn't have much storage capacity for crude. It needs its ships for getting all these reorganizations done. This leads to together with the desire of its main clients to import crude, not products, because they like to refine it themselves and reap these margins. This leads to pressure on Russian inventory holdings in crude, and that has led in January at least to an uptick in crude exports, because they couldn't get absorbed by Russian domestic refineries and couldn't be transformed into products anymore, and that has exercised some pressure on crude. So that's the bigger uncertainty factor. And then, of course, the background is like Mark said. They will cut. Like Mike said, I'm sorry. They will cut or they will not cut, depending on political consideration, which is out of scope here. And if you take that together, to come back very quickly to your question, then you have very stable supply situation actually going forward, and it becomes indeed more of a game of demand than we have been used to in the last few months. In my view, global demand is pretty steady. So I don't see, even if you get recessions, I don't see them associated with a big decline in production and GDP, which would lower demand substantially. Demand will be lower than it has been in the past. And this tends to add up to a situation pretty much as forecasted by the major forecasting areas, where you have decent demand growth, but still no situation in which you get excess demand in the markets. Okay. So therefore, a steady to declining price outlook.
So declining. Others, Mike, would disagree that in the second half of this year, we're going to see prices rise up beyond where we're seeing them so far this quarter, and that China demand will in fact really kick in then. What's the latest from the East, from the Chinese sort of expectations? Some people tell me it's going to struggle to do that 5% GDP growth. Others are saying they're very bullish about the second half. We have a big parliamentary congress coming up for the first time in China since COVID. So what are the recent what's the recent sentiment coming from the reality on the ground, if you like, of how much pull China will bring to energy markets?
Yes, indeed. In the lead up to the Congress later this month, China has made some policy statements, and China has had some better economic news. In the weeks after Chinese New Year, the net migration figures weren't quite as strong as some had predicted they would be during Chinese New Year, because for the first time in 3 years, Chinese city workers were not told to refrain from going to visit their families in the countryside. But we have seen the beginnings of a reasonable uptick in air travel. We have to remind ourselves, though, it is still not possible to visit China as a tourist. They're not issuing tourist visas, and they're not allowing people to go on tourist trips leaving China either. So it's only open for business travel. And therefore, the vast majority of the Chinese commercial aviation fleets are still not utilized or grounded. And it is that pent-up demand that everyone's expecting will be unleashed at some point later, because there are no COVID concerns. I was fortunate to visit Shanghai just under a month ago, and we have travels planned back into China again. And I mean, the mask wearing is the same as it is here in Singapore. Of course, Shanghai is perhaps not representative of China, but there's a lot of construction, lots of cranes, even some structures that looked like they were, consuming lots and lots of concrete. So we know that the property sector is the one that was the Achilles heel in China and had obviously had a knock-on effect to steel and all the other ingredients, cement, that go into construction in the first place. But there do seem to be some very real policy incentives for provincial governments to start building roads, construction, municipal buildings, et cetera, et cetera. The congestion was very much normal, and everyone's saying that that things are busier. For example, if you go into Shanghai before COVID, they had such a congestion problem that they had to rule out certain number plates on certain days. So when my colleagues connected me from a city outside of Shanghai, they had to come into the city the day before because they couldn't have driven into Shanghai to pick me up in their car. So everything's back to normal in that sense. But I think this has led to a sense of optimism, as you said, Diala, in terms of the second half of this year, seeing a surge in Chinese demand, not just for jet fuel as the Chinese tourists come back and vice versa, but in terms of just a Chinese economy with full support of a pretty cash-rich central government, consuming more. And we see it in the behavior of the Chinese actors in the oil and gas space. On the gas side, there's been a severe winter drought in Yunnan, so the hydroelectric power is not there. So that would lead to more coal and LNG imports potentially. But we're seeing it in terms of reduced exports of petroleum products. In stark contrast to what we had in Q4, when there was a policy directive for Chinese refiners to crank up their runs and maximize exports in what some people believe was an attempt to improve the trade balance at the tail end of the year. Those exports all but dried up because domestic margins were good, domestic consumption was good, and there seemed to be some desire to build inventory as opposed to putting it into the international marketplace. So China went from supplying too much oil to not supplying very much, and that gave us a rather bullish tone straight after Chinese New Year. And now the question is, what from here? It's awfully difficult to read, of course, but that just serves to illustrate that the market is justified in feeling upbeat and positive about Chinese demand growth. Most analysts seem to have been revising their estimates for Chinese oil and gas consumption up for the balance of this year, substantially so, which will make 2023 one of the biggest year-on-year demand growth stories that we've seen, with the big ones being, I think, 2009 and 2001 or 2, if I remember correctly. In one of those years, just after the turn of the millennium, China grew by 2 million barrels a day of oil demand year-on-year. So the fear of that happening again has the bulls talking their book and suggesting that we could enter a world where spare capacity is in the hands of Russia and Saudi Arabia only. And effectively, that is base case for many people going forward into the second half of the year. And if you then look at where the spare production can come from, you look at escalating costs for producing shale liquids in the US, and people not necessarily deploying the number of drill rigs that we would have expected a few months ago.
Okay, great. Thanks, Mike. Christoph, just on that question of Saudi and sort of where the spare capacity is, just let's touch a bit on OPEC today in terms of, you know, what it may have recently been saying in the last month or two, and what it's projected. Many people saying it's really going to find it it's going to resist very hard to change its production plan through to the end of this year. Clearly it can tweak things whenever it wants, but it's been quite vocal about that in the last few weeks. What would you say to that? Do you think they will stick to the plan? Do you think they'll reverse some of the cuts they did last year? How much has the Russian unilateral sort of action impacted their thinking, do you think?
Well, first of all, OPEC has never said they have a plan throughout the year, tied their flag to the mast that closely. They have regular meetings. They have regular meetings, which gives them the explicit option to reverse their decisions. That's why they're meeting monthly, and so I think that's a big part of this kind of flexible answer. Is a big component of their policy of not tying themselves down to something in this age of uncertainty. And secondly, I think it's perfectly possible not to be a bull on China. And I've heard these China stories now since the COVID outbreak, and it never have happened. To not be a bull on China and still to believe that the only spare capacity for the rest of this year will be basically concentrated in OPEC countries, which I think remains true. We have a very low buffer safety margin in oil markets. We had this for a while. But we are seeing also supply responses from elsewhere in the world after now 2 years or so of prices above 80 or around 80. We see shale growing. We see slower than expected, but steadily, and the costs of shale are still much lower than they were before COVID. We see responses from Guyana, from Brazil, from other areas sort of coming. We see, as we always do, problems in Libya and in Nigeria, which may or may not reverse. So I think by and large, it's fair to say that we have safety margins concentrated in the Middle East and OPEC, and that we have demand growth pointing at an upward tick of demand, but probably, in my view, because of China, not a huge jump in demand, because China will not go back to these pre-COVID growth rates economically without a stimulus. So it will be just a catch-up situation. And what this points to is that the question really for further uncertainty are there cracks, not in OPEC, but in OPEC plus? What is going to be the relationship with Russia and its desire to keep prices higher? And Saudi Arabia and the UAE, who probably can live with prices like they are today quite well. Is there a new dynamic developing or not? Again, this leads us back to politics.
Yeah, well, I mean, and on the politics, apparently Saudi Arabia, which is kind of obviously leading OPEC, is prioritizing keeping Russia within the group no matter what. And many say that the $500,000 unilateral announcement was fully sanctioned by Saudi, and obviously it was aware that was going to happen. Christoph, just sticking with you, let's talk a bit about gas. Mike mentioned gas price outlook for Europe, then we'll talk about Asia maybe, Mike. That situation seems to have completely calmed down in Europe. Lots of storage ahead of next winter now. 2 months ago, people were saying next winter is the problem. Actually, now it doesn't seem to even be a problem, some people are saying. Where do you see that trajectory going? Has Europe completely, got itself weaned off Russian gas and is all set for next November, December?
Yeah, this is really interesting. So some of us have always been saying about next year, a train which you see coming isn't such a big problem as a train which hits you unexpectedly like this year. So what we see now, prices coming down, but we also have to say that Europe took a big hit. I just, before this talk by accident, saw Reuters when they had numbers on Germany, and they claim, and it's probably true, has been published by the government at least, that as a result of these high prices in 2022, consumption was down by 1/3, import of gas for Germany. But prices had been risen so much that their expenditures for natural gas doubled, despite a fall in consumption of 1/3. So that was a very costly maneuver, and a country like Germany is probably possible to sustain that for a year or so, but even the richest countries couldn't do that in a prolonged manner. So if gas markets now continue to produce, and if the prices are where they are today, which is still a lot higher than a few years ago, then the situation will calm down. But economically speaking, Europe is now certainly more vulnerable to another price spike than it was before. What I think was very important to realize is, because people in this industry, they always talk about price volatility as something bad, with the exception of traders. But what we have seen is that only because of the ability of prices, energy prices, to spike like they did, was a real sort of crisis in terms of not enough gas availability avoided. And I take higher prices in the short term any time of having to freeze through the winter. And I think that's an important lesson here, which should sink in.
Mike, any concerns in Asia about access to gas? Last year, we had Europe sucking in a lot of the US sort of replacement gas, if you like, for Russian gas, and competing against Asian buyers on pricing. What's the feeling there in terms of, assuming that we're going to see demand increasing in China, etc., and other Asian economies?
Yes, it may not be so much China as other Asian economies. I'm really glad you raised this, though, because I think gas and LNG has been taking up a lot more time in leadership team meetings in all companies in our sector than anybody ever expected it to. And of course, we have, thanks to the warm weather and the absence of demand for Russian, we've seen an overstocking and a more comfortable position in Europe, and a weakening of the price set. I mean, US Henry Hub, of course, is a landlocked index, as is TTF, but Henry Hub is below $3, and TTF is trading around $15 in MMBTU, or 47 euros per megawatt hour. At that price, LNG starts competing away the rather unusual state of affairs that we've gotten used to for more than a year now, which is that utilities burn diesel instead of LNG. So LNG is now competing again, and therefore it's going to force its way into the mix and push out a bit of diesel. And lo and behold, not just that, if it stays at these levels, you'll see entire sectors that were uncompetitive because their gas feedstock or fuel was too costly and therefore enterprises are shutting down. Famously, large German petrochemical companies, but certainly less high margin businesses like cement and paper and fertilizer, for example, resuming consumption in places which no longer have a high gas cost. So out in Asia now, I mentioned it's not so much China. Of course, what happened in Asia when the LNG prices went to these crazy levels is the Asians turned their back on it, or put differently, demand destruction occurred. And all the attention swung to coal. And Asia was fortunate to have plenty of coal at its disposal. And the Chinese had a couple of extra access to gas pipelines. So LNG year-on-year consumption in China was down something like 20%, which nobody would have ever seen coming. But South Asia was really where you saw the massive impact, because there it wasn't just switching fuel, it was just choosing not to have supply. So not having 24/7 supply of electricity was the norm in many South Asian economies. Those South Asian economies are back and they're buying, because to them LNG in the mid to low teens works. And that then does two things. It creates more demand for the LNG, and it creates a more global balance where there might be a redirection of Atlantic Basin LNG cargoes this way to Asia, but it also stops people burning expensive diesel. So whether that's material enough to counter the current tight diesel market and the concerns people have, plus the disruptions that I'll maintain are in place because people don't quite know how to deal with the price cap yet, hasn't yet played out. And it's always the case because markets trade a month out, and sometimes legislation comes into force in a matter of days. We had 1 day's notice on February the 4th, which was a weekend, and the EU said that they would review this every 2 months, and the next review is on March 15th, I believe. So very, very difficult to judge. But no, gas is now at a point where it's at an equilibrium level versus other fuels, and it's a very interesting market right now.
Okay, well, and you mentioned South Asia. We had somebody on from Pakistan earlier this week saying that, of course, that economy is in dire straits, but that their natural gas, local and domestic natural gas prices were increased 112% overnight. That's, of course, the mechanics of the internal pricing plays into that. But again, some economies very vulnerable to that. Christoph, as we wrap up, let's talk about economies. We haven't even mentioned the Fed. We have to talk about them at least once on today's program. There's been, last month in February, talking about the month in review, for a week or two, the markets were still, the equities markets, I'm saying the financial markets, were all abuzz with the fact that, okay, the Fed's done its job, and this sort of, I suppose, fake exuberance came into play, and then reality hit again. Where are we with the Fed policy in terms of the, higher for longer sort of rate policy, and is there has been any sort of clarity on whether it's going to push things any higher? People were talking about above 5%, 6% in the last week or so.
It's an economy starting in the US, which is actually, it's true, it's very hard to read, because we have numbers coming in with record employment figures still, very low numbers of people seeking employment. And at the same time, when you look at forecasts of output and so, then there's always talk about recession. And now we have to keep in mind, recession is just a technical term. It just means 2 quarters of low growth or negative growth. And this could take place at very high activity levels. So you would look out of the window and you would say, but what recession? And that's kind of the situation we are in. And that has that continued underlying strength of the economy, no matter how this plays out year to year, so in the numbers, has led to the revision and the assumption that the Fed has done with cutting. The Fed will continue to cut a little bit. That's one thing I think is obvious by now. The other thing is obvious that the Fed, despite all the talk, will not kill the economy and bring inflation overnight back to 2%. So they're probably quite happy with 3 or 4%. So that still looks to me like a soft landing at a slightly higher interest rate than today. The bigger problem is in Europe. And in Europe, you have behind the curve inflation rates just over the last week in France and in Germany and somewhere else have come in much higher than expected. Lagarde was very reluctant and slow to jump on the train for the Fed, which also gave the dollar much strength and the euro much weakness, reinforcing these pressures on prices. And Europe, of course, is still a very heterogeneous area, which has a common monetary policy and nothing much else in common in terms of fiscal policy or economic policies. And that means if you now would enact the kind of interest rate increases which you need to keep inflation in check in France or Germany, you would hit places like Greece or Italy or so disproportionate. Some mix, therefore, is necessary, and the mix always means it's so suboptimal, worse than it could be for someone in this huge European aggregate. My take is that they will have to now raise a little bit longer than markets expected. And the outlook for Europe had turned quite bullish on the back of being behind in interest rates behind the US. Will turn a little bit as it becomes clear that the ECB cannot get away with cuts substantially lower than what we have in the US. But in the end of the day, in terms of real rates, both will be below what is required to really kill inflation quickly, despite what the talk is. And then you have Asia and China. We talked about this quickly. I agree that with Mike and others that there is this reopening and that it will boost economic growth. But you have to always look at the benchmark. China will not come back by itself to 10, 12, 13% growth. It will be 3, 4, 5, 6% growth in a little blip before, except, and I would still not rule this out, if the Chinese leadership decides to provide a stimulus. If it does so, then this would be interesting, because it would be unlikely to be a traditional stimulus, more houses, more roads, more infrastructure, because they have already too much of that. Mike has referred to it. Housing is a problem because of too much of it, not because of too little, and financing problems. They will have to provide a monetary stimulus, similar to what we have seen in COVID in the US, where basically everybody gets a check and people are still spending the money they saved during the COVID period. That explains these high activity levels despite the talk of recession. If that happens in China, then we will see a substantial boost of everything, including oil demand. If it doesn't happen, we'll see demand growth ticking up as we have seen so far.
Okay, Christoph. Mike, we'll let you have the last word for a minute on that point. I just want to talk to you about China, Asia, so debt, again, the debt equation, if you like, that plays into that. I mean, do you see China sort of easing its monetary policy a lot? It's already corporate, private, government debt is at very high levels, as it is everywhere in the world. How careful do you think they'll be about that for the sake of boosting demand? And other people are saying the only way Chinese demand, China's economy will really perform is if its property sector recovers. So your quick point of view on those 2 points to close up. Oh, we've lost, you're on mute. Sorry, Mike.
I apologize. I think on your last point on property, it's hard to see how there could be a quick turnaround. I do think Christoph has a very valid point that China is going to introduce stimulus, but in terms of their monetary policy, it isn't really broken, and therefore I'm not sure they're going to do anything destabilizing. They seem to be on a trajectory they're happy with. Most of the world's opinion is behind China pulling through, and of course, as Christoph alluded to, China will only grow if the world will buy its produce, and therefore we don't want a recession. The Chinese don't want a recession in the rest of the world, and therefore it's in their interest to keep the cost of raw material down, and that's why perhaps we're seeing them participate in the discussions now around supply security on commodities a little bit more vocally than was the case before. But I've always on these calls been very upbeat and often criticized by Christoph for being too positive about China. It's not just because I go visit there every month. I do think China will do its bit, and if the rest of the world can stay out of recession and start consuming, and they no longer have the cost of living crisis quite as acutely as was the case a year ago, when instead of buying 2 shirts, a pair of jeans, and some toys for kids at their birthday and having a second holiday, they had to pay a more expensive gas and electricity bill. Now they can consume again. And that's a very simplistic take of mine, would hopefully rev up the engine for more containers to head across the Pacific to America and across the Indian Ocean through the Suez Canal to Europe. And then everything looks good again.
Yeah, and China, as you said, will always continue to do its bit, but many are saying that the era of it being the pull for sort of global demand across the board is perhaps over. Mike Müller, head of Vitol Asia, and Christoph Ruhl, senior research scholar at the Center for Global Energy Policy at Columbia University. Thank you so much for joining us for the month in the review and the look ahead for the months ahead. Thanks so much for your time.